Welcome to Investors Insights. Our topic today is blessings and markets. I'm joined by my colleagues, Bobby Norman, Trey Booth, and Ty Miller. And in our discussions, we want to recognize those men and women who served our country, who gave their lives to give us the freedoms that we all have today, the blessings that we have. We are all so fortunate. And in this world of volatile markets and news headlines and everything that's going on, may each and every one of us remember those who served our country and who believed in democracy and freedom and so many freedoms that we have today. And so with that, we're here today just to talk about going forward that maybe we need to all look at our blessings. Despite what the market headlines are, there's a lot of great things going on in this country and this world. And with that, Bobby, I would like to start with you because you had some good news in regards to looking at the economy. So let's talk about that.
Yeah, so there's been a lot of talk recently about a pending recession or an economic slowdown. So I want to talk about a recent report that came out last week that shows economic activity in the U.S. is actually growing at the fastest pace in 13 months. And I want to share a chart.
What? The fastest pace in 13 months, Bobby?
You heard that correctly.
That's not you're not hearing that on the news.
You're not. And I want to share a chart that shows that the Purchasing Managers Index composite outlook going back to 2007. First, let me explain what that is. This economic indicator is a weighted average of the Manufacturing Output Index and the Services Business Activity Index. We follow this report because it is an important leading economic indicator that provides valuable insights into the state of the U.S. economy in general, but more specifically, the manufacturing sector. As you can see in this chart, the indicator hit 54.5 in May, which came in better than expected and the highest in 13 months. Any reading above 50 represents expansion. So we're at 54.5. That's great. So this is great news that shows economic growth. However, for investors hoping for the Federal Reserve to pause rate hikes, this report might pose a problem because of how a growing economy could lead to higher inflation. So something we'll continue to watch and how positive economic reports impact the market. But this is great news if you're following the economy.
I really appreciate your research and report on that, Bobby. And then Trey, from your standpoint, let's elaborate on that topic in terms of consumer and the economy.
Yeah, absolutely. Thanks, Greg. So something we've been tracking is an indicator, the consumer stress indicator created by our research friends at Strategas. You can see on this chart what it does is it takes the food inflation plus mortgage rates plus the gasoline inflation and compiles a common indicator to show how much stress the consumer is under. And the bad news is we've been over 10% for 20 consecutive months. That's the longest stretch going back to 1970s. But as you can see in this chart, the good news is while we're still elevated, we are way off the lows, 23.6% earlier this year. We're sitting right around 17%. That's partially due to lower mortgage rates, largely due to falling gasoline prices and a little reduction in food inflation. This is a great sign for the consumer heading into the big summer driving season. But we don't want to be overconfident in this because we have done several vlogs recently on the risk of potential higher gas prices because we have seen a cut in OPEC production. So you have an increase in demand, a cut in supply that typically leads to higher prices. So it may not be a permanent relief in the consumer stress. And then add to that, you can see on this chart that mortgage rates have started to pick back up as risk of higher interest rates. To Bobby's point, pricing in the chance that the Fed may not be cutting rates because the economy is doing so well. That pushes interest rates back up. It's kind of a catch-22. You want a good economy, but that good economy comes with higher interest rates, which then can come with consumer stress. So it's a delicate balance we're dealing with right now, but something to be thankful for while we got it. I'll take the lower prices now. It just may not be permanent. Kind of prepare for the summer. Keep your gas tank full because you may want to drive it down as prices spike.
Well said about being thankful for it while we have it. And also a balancing act, or as we like to say here, navigating through all the market conditions, but still really good positive news. Ty, you brought up about debt ceiling. Everywhere we turn on the news media, it's gloom and doom. Talk about that to us.
Yeah. So as we all know, debt ceiling, needs to be raised. The decision is expected to be made in early June. They're shooting for June 1st. Our research partners are telling us maybe June 7th, June 8th is kind of that X date, but June 1st is an encouraging sign that, they're coming to the negotiating table early. Hopefully we can get something passed here. We're still optimistic on that front. With that being said, once it is raised, that'll be a big change. So right now, of course, we have the Fed, doing quantitative tightening. They kind of paused that for the time being. We expect that to pick back up. But where we sit right now, the Treasury General account, where Janet Yellen kind of operates, is pumping some liquidity into the system. But that balance in their account is down to 68 billion roughly. And so that's kind of a level where that X date comes into play. And at that point, government would looking to issue in treasuries $1 trillion worth of treasuries. What's that going to do to rates is going to remain to be seen. But what that is going to do is take liquidity out of the system. When they issue bonds, people got to pay for those bonds with money, which they're collecting. At that point, that's really going to change kind of market attitude and something we're going to look at going forward to try to navigate this time as the debt ceiling comes across. They're going to have to up that Treasury General account from 68 billion to at least 500 billion, if not more. And Trey uses a good example that I kind of want him to share with you guys.
Yeah. So what's been happening with the Treasury is, so we run, as everyone knows, we run a deficit in the U.S. So we borrow money to fund money. So what we do is we borrow money from Peter to pay Paul. That's kind of how the government works, and they're kind of the intermediary. So when we hit the debt ceiling, we can no longer borrow from Peter to pay Paul, but we're still paying Paul. And so what that is, the Treasury is just putting money into Paul's bank account without taking money out of Peter's bank account. What happens when they raise the debt ceiling is the Treasury goes back and says, "Hey, Paul, I need all that money." And so then it takes the money it would have taken from Paul out of his bank account and to refund what the money they gave to Peter. So for the last 6 months, we've had nothing but Treasury money going into the banking system, into the economy without the counterbalance. And all at once we raise that debt ceiling, that out of balance comes quickly into balance. And so that sucks liquidity. What happens in the market is the unknown, but it is a big rebalancing of liquidity all at once.
As you see in this chart, that's how we got down to 68 billion. And then you see how we try to have, taking that money back from Paul, we kind of see that rapid rise of what we expect to happen to refund that general account.
Great explanations, gentlemen. Put in terms that everybody.
My apologies to all the Peters and Pauls out there. No.
You did a great job, Trey. Ty, thanks for bringing that to our attention as well. And folks, please know that as you watch our vlogs, track us with the information that we provide. We've already referenced some past comments that we've made in other vlogs. We also appreciate you sharing it with friends, family, and neighbors and colleagues. We also appreciate your comments and feedback on our social media, on Facebook, LinkedIn, Twitter, our podcast, YouTube. So we want to communicate in multiple ways. And again, I just want to emphasize, we hope you have a very happy Memorial Day and for the rest of the week. And we all move forward knowing that we have a lot of blessings and we're so thankful. And we just cannot say enough appreciation and respect for those who gave their lives so that we could have the freedoms that we have today. So with that, we hope you're cooking out. We hope you're with family and friends, and we will look forward to keeping you updated as the week progresses. Thanks.